Hello everyone, it's Michelle Bailey, real estate advisor with Sotheby's International Realty Canada. And today I'm speaking with life insurance and estate planning specialist, Michael Dutra.
How hot the real estate market has been right now. And I think one of the things that's risen or come from the pandemic has been people trying to exit from the cities and escape, whether it be to the country, whether it be up north to cottage country, or whether they're going to find themselves, a resort living lifestyle place, such as you'd find in a spell with Friday Harbor.
And that's a very good question, and a question I get a lot of the times. Families are buying cottages or vacation homes or rental properties, and they're looking to keep these properties for future generations, children, grandchildren, etc. Now, one of the issues that often catches people off guard is, as you said, the rise in value of real estate has been incredible. And there's a huge positive to that because now your assets are worth more. But perhaps the negative side is, if you bought a cottage a decade ago or decades ago, you probably only paid at most a couple $100,000, maybe not even. And now these properties are worth $1 million plus. So the gains are just so massive. And that's where the issue of the tax bill comes in. And a lot of people don't realize you can't just pass down properties to children or grandchildren. There's going to be a tax bill that has to be paid. And unfortunately, this tax bill sometimes is too expensive to afford. So they're forced to sell the property. And sometimes it's a fire sale and you're selling at the wrong time of the market and you're losing more than perhaps you should. So it's important to be aware of this capital gain issue. Secondly, it's important to be, how do you calculate this? And how do you calculate the tax bill today? But if you have 10, 20, 30, 40, 50 years to go until you end up passing this property down, this tax bill is only going to grow. So, we have to come up with a solution to address a future problem. And that's really, how you tie in life insurance for people who own multiple properties and are looking to pass it down. I like to explain life insurance as buying a future amount of money at a significant discount today. So you're going to need this, right? You're going to need this lump sum of money in the future. That's a guarantee. This tax bill isn't going away, but you're going to be able to pay a little bit for it today. So just planning for that and just being aware of that, it's going to really help you keep the cottage or the Florida home in your family for generations to come. Eliminate stress. Nothing's worse than having an estate with a huge issue of tax and there's no way to come up with the money. So certainly, life insurance is something to look at if you're looking for intergenerational planning of properties.
Right. Yeah, especially with capital gains. And, we're seeing these properties going bidding wars right now up in Muskoka. They're selling 500. I think I saw something the other day, 800,000 over list, something crazy like that. So, it's a special time in the real estate market. And it's good to know that there are some things you can do to avert a crisis later.
There certainly is. And more often than not, the insurance is more affordable than some people might think. There's different ways to pay for it and stuff like that. But when you look at your options of, not doing it or doing it, mathematically, it makes sense to do so.
So then, what about people who put these properties in a corporation or holding companies? What are the implications there tax-wise?
Yeah, that brings a new layer of tax. And unfortunately, there can almost be what they call a double layer of taxation, because if you have a holding company or a corporation that owns rental properties, your office or vacation homes, when you pass away, you have to pay the capital gains of these properties inside of these corporations. But then there's the risk of now having to take the properties out of the corporation, which adds a second layer of tax. Now, if you have a good lawyer and accountant, there's ways to minimize that. But nonetheless, the tax bill is still present, even though it's in a corporation. So something interesting, when someone owns a life insurance policy, or the company owns a life insurance policy, so the holding company or the corporation owns the policy, the life insurance policy is in the corporation's name, and the corporation is the beneficiary, meaning when these people pass, the money from their policy is paid to the corporation, not to them personally. One of the goals I try and advise on is, you want to take out as much from the corp as you can on a tax-free basis or with minimal
Right.
tax, right?
Yeah.
So some people don't realize, life insurance sometimes is more about just the death benefit. There's some perks that come with it that I like to call. And when a corporation owns a life insurance policy, one of the perks that comes along with that is something called a capital dividend account, CDA for short. And what this ultimately means is you can have a credit towards this account. All right. And say the credit is, you have $1 million credit.
Mhm.
Well, there's only 4 ways to credit this account. And one of the 4 ways is life insurance. The other 3 are very different reasons. But when a life insurance policy is paid to a corporation, it credits this capital dividend account. So say you have $1 million credit. Now you're able to take out assets from your corporation up to that credit, up to that $1 million. So if your property was worth $1 million, you can now take the property out completely tax-free because of the credit this life insurance policy gave to you. And if this corporation is staying open because maybe your adult children are shareholders, then not only do you get the life insurance proceeds paid tax-free to the corp, so now you're liquid, you have cash. You can also now take a property out of the corporation on a tax-free basis. So it's just so impactful and so important to know. It's not just about the death benefit. It's about some of these credits you receive and some tax planning and significant estate planning benefits that people are going to get.
Right. I never, you don't really think about life insurance or insurance policies in this way. At least I know I haven't. So this is like, for me, so informative. Something else I've heard is that you can get money back from a permanent life insurance policy. Now, explain that to me because, again, mind blown. So
That sounds good, too good to be true sometimes.
right.
So, right, when people typically, I find when people think of insurance, they'll think of car insurance, house insurance, and that more or less is money out the door unless your house floods or you get an offender bender or something like that.
Exactly.
You can't call the car insurance and say, "I've been paying for 10 years, I want my money back." It just doesn't work like that.
Right.
I wish, but not so much, right?
Right.
Now with permanent life insurance, and I'll talk on a whole life policy, for example. Not only do you get the life insurance, it's permanent, you're going to own it for the rest of your life, but as you start paying into it from the first month, it comes with an investment account. It's known as the cash value. And every single month as you pay your premiums, some of your money actually goes into this investment account and it grows on a tax-free basis. And the way it grows is the insurance company will pay dividends into your policy. So just like owning bank stock, every year or every quarter they pay out dividends. Same thing with the insurance companies paying dividends into these permanent life insurance policies, and it can grow quite substantially. So, a few years into the policy or 5 or 10 years down the road or even longer, you have this really nice nest egg that you can access the money while you're living. So I call it kind of the living benefit of life insurance. So as an owner, as a payer of the life insurance, you can literally access the money while you're living to do whatever you like with it. One of the common ways to do so is to borrow against your policy. And sometimes I bring that up and some people kind of their eyebrows raise, but it's just like putting a mortgage on a home. The home is the asset and the bank's willing to loan you against your asset, loaning you a mortgage.
Yeah.
So the insurance company takes this cash value, this investment account, and because it's so stable, they use it as collateral to give you a line of credit against it. So it works the exact same fashion. There's a few extra benefits though. You can pay interest-only payments, so it lowers the cost. The interest you're paying can be tax deductible as well, and basically you're able to access the money, as you're living, as you see fit.
Yeah. I mean, I heard about it and I didn't believe it when someone had to do some work on their property. It was in 2008. It was a time of the financial meltdown, and they could not. They were fluid poor at the time. They couldn't get their hands on money from the bank.
Yep.
And this is how they got the funds to make repairs to their property.
You're right. It sounds funny, but a lot of people, do it for renovations or down payments on properties or rental properties and stuff like that. You're essentially your own bank. You're financing yourself. It's your own asset, and you're using it as collateral. And you don't have to go through all the hoops of the financial statements and TDS ratios and GDS ratios and stuff like that. It's actually guaranteed in the contract that you have access to this.
So then, hold on a second.
Yeah.
Just take a step back. So what are you actually saying, that someone can use their insurance policy to buy real estate? Is that what I'm hearing?
In summary, yes. Big picture, yes. You could literally, you need $100,000 down payment, and you have that in your cash value. Within, like, sincerely days, you can have access to this money and use it for any purpose you like. And then you can have your rent, say it was a rental property, the renters could pay the interest off on the line of credit you've just received. So you're literally self-financing yourself with no out-of-pocket expense and having your renters pay for it.
I don't know. For me, I think that's brilliant.
Yeah.
I think it's very smart.
It's a very smart strategy, yeah.
So then, the reverse of that, can someone use their properties as collateral to reduce the cost of their life insurance?
So here's a different spin on it. So instead of using the cash value to purchase property, now we're talking about the cost of life insurance in general. So I completely understand, insurance isn't exactly something someone wants to throw money at. I can understand that.
Yeah, because you usually think of it as I did, before we started chatting. I really thought of it as like, you're just giving money, it's going out the door, it's never coming back. Right. You don't have the accident, you don't have the problem or the flood in the house. Right. It's just money out the door. I never saw it as something that could be utilized in a beneficial way. Let's put it that way.
Absolutely. So in a scenario where someone has one extra secondary property or multiple, what they can do and what the insurance company will do is, if they're willing to pledge these properties, a portion of the equity as collateral, the insurance company will allow them to pay interest-only payments on their life insurance policy. So in other words, if someone needs, a multi-million-dollar policy, and maybe it's going to cost them a couple $1,000s a month in premium, so maybe it's $30,000 a year in total premium, but you're getting, a couple $1 million of life insurance. Maybe they're, at this point, they want to reinvest their money for other purposes. So they don't want to be out of pocket that 30 grand every single year. Well, in that scenario, if they had a property that's, perhaps paid off and collecting rent or whatever they're doing with it, they can pledge that as collateral, and the insurance company will use that. And now they can just pay interest-only payments on their life insurance. And it significantly reduces their net cost. Right now, interest is, give or take prime, depending on which insurance you do it with. So it's just such a low way of getting large amounts of life insurance, and just using your own assets to really help keep your costs down. And of course, there's some extra bits of information that have to be involved with a strategy like this, but big picture, that's more or less how it works. You're using your own assets, your properties, to minimize the cost of your life insurance. And it's very commonly done amongst people in the real estate industry.
Well, since we're talking about all things insurance, I think we should touch upon mortgage insurance and some of the pitfalls that are associated with it. Can we speak a little to some of the risks there?
Yeah, this is the thorn in my side right now. You're going to get me.
I'm being polite. I'm trying
to get me going on this.
I'm right? Cautious of what that fine line, but I'd love for you to explain a little bit for people to learn about.
So, a few things. When people have the right intention, you buy a home, you get a mortgage, you have a family. The last thing you want is, if something happens to you, you don't want to leave your family with a large debt. Okay, 100% with the right intention to do. Doing that through mortgage insurance is not the right way to do it. And it sounds funny because it's called mortgage insurance. So why wouldn't you buy it or use it against your mortgage? It makes sense, right? Yeah. So there are some very, very big risks with mortgage insurance. Mortgage insurance was not the original way people were insuring their mortgage. And I'm going to talk on what that was. But mortgage insurance came after. So there's 3 or 4 points I really like to make that people really need to know about the risks of mortgage insurance. Number one, the lending institution is the beneficiary. It's not your family. So there's a very big difference if a spouse, a parent passes away, and let's just say the mortgage insurance, what they would do is remove the debt, remove the mortgage. Okay.
Yeah.
That's, I mean, removing a debt when a parent passes is great, but it's very different than the family receiving a tax-free lump sum check to decide what to do with the money now. So if your mortgage was $500,000, so option one, you remove the debt, so you save a couple of grand a month in expenses versus getting a $500,000 tax-free check and now deciding what to do with it. Very big different options. So the bank is the beneficiary, which is a problem. Number two, it's a decreasing coverage, but your premiums stay the same. So from the first month you get the mortgage for 500,000, you're paying say $50 a month for this mortgage insurance. You're going to pay $50 a month indefinitely, but every single month as you pay a mortgage payment, your mortgage is going down. So in theory, your coverage is actually decreasing, but your payments stay the same. So that really doesn't make any sense. Another point is the health. So usually you just initial, you get approved for the mortgage insurance. You don't do blood work, you don't do medicals, you don't do much underwriting.
Yeah.
Huge risk. Down the road, 10, 20 years, they look back and they say, you know what, you didn't tell us you had this, or we didn't know you had this heart issue or this, health issue. And if you Google it, there's horror stories of families thinking they had this coverage and, they're letting it decline.
Yeah.
So then what's the answer? What's the real way to do it? And that's with term life insurance. So term life insurance is the original way to cover a mortgage. It's the only way you should cover a mortgage. And in that sense, say you have a $500,000 mortgage, you'd get a term policy for $500,000. Now, if something happens to one of the parents, well, a tax-free check of $500,000 is paid to the family. Now they can decide what's the best use of this money, because oftentimes paying down all the debt instantly and rushing to do that doesn't make the most sense. Cash is king in a scenario like this. You've lost one of the incomes,
exactly,
other expenses. So you want to be able to have some options with the cash. So your family's a beneficiary. That's huge. Number two, say it's $50 a month. You're paying for the $500,000 of term. You're always insured for $500,000. It doesn't decrease as your mortgage decreases.
That's correct. Yeah.
As the years go on, right, you get this healthy gap between the $500,000 of term and what your mortgage balance is. So 15, 20,
it only makes sense.
It only makes sense, right? And then you do all the underwriting at the beginning with a life insurance application. You go through the health questions. You might have to go through medicals depending on how much you need and age and that sort of thing. So it's a black and white. It's a contract you have. They can't take it back as long as you didn't lie on the application. And it's cheaper. Mortgage insurance is actually more expensive per dollar of insurance than term insurance is. So I don't get it. It's more of an information thing. I just don't get it.
I was speaking to at the time, but I personally have term insurance, and I believe firmly in it. Yeah.
Right. Absolutely. So it's an educational thing. I wish I could tell everyone in the world that, inform them on that. It's just so important to know.
I think we've covered all the questions.
Yeah, we absolutely have.